What would define a bubble? You have to make implausible, not impossible, but implausible growth assumptions to justify today's price. That's part one. And part two, the marginal buyer doesn't care about discounted cash flow models. They care about the narrative, the story. Never short sell a bubble. Bubbles can go further and can last longer than you can possibly imagine. If you go back historically and you sort companies based on R&D expenditure, that's positively correlated with subsequent success as a stock. CapEx tends to be negatively correlated with future stock market performance. If you look at NVIDIA, they have very happy customers. People are lining up for the privilege of getting on a waiting list to spend vast sums on the most expensive chips in the history of computing. NVIDIA's customers have yet to find any way to transform that CapEx into revenues and profits.
Hi, Rob. Welcome back to Excess Returns.
Happy to be here.
It's always a privilege to have you on. You always bring your A game, and that is a mix of data, evidence, historical perspective on markets and the economy, and a lot of times, a non-consensus but heavily weighted sort of view on the markets and sort of what we're sort of seeing in the market today relative to like its historical context. And so we always sort of get a lot of value, and our audience does too, by sort of having these, longer discussions with you. And today we wanted to talk to you about, get your views on the market, talk about, whether or not we may be in a bubble or if there's bubble-like areas of the market that investors should be paying attention to, and sort of a whole host of things around that. And then also get into some of the research that Research Affiliates has put out recently, because I think there's some very interesting stuff that you and your team over there have been working on. So hopefully people, stay with us and hear about that research, because it's important to be thinking about as investors. So to start, let's start on the bubble conversation a little bit. And, it's always hard to know. It's always easy to look back, but it's sort of can be hard to know when you're in it, whether or not we're in a bubble or nearing bubble-like territory or whatever. So just, can you kind of walk us through how you think about looking at bubbles and assessing whether or not, the market or areas of the market might be in a bubble?
Sure. Well, firstly, just as the dot-com bubble, lots of people identified it as a bubble while it was happening. A lot of folks are starting to identify this as a bubble while it's happening. Now, that doesn't guarantee that we're right about it, but if you stick to objective facts, you're less likely to be wrong. One cautionary note, never short sell a bubble. Bubbles can go further and can last longer than you can possibly imagine. So be very careful about betting too aggressively against a bubble. That said, bubbles do happen. Back in 2018, we wrote a paper in which we offered a definition for the term bubble. The term bubble is too often used and too rarely defined. And we offered a definition that can be used in real time. And I think that's important. What is that definition? Well, the price of any asset is supposed to be the market's best guess at the discounted net present value of all future profits distributed to the investors. All right, that makes sense. So what would define a bubble? You have to make implausible, not impossible, but implausible growth assumptions to justify today's price. That's part one. And part two, the marginal buyer doesn't care about discounted cash flow models. They care about the narrative, the story. Bubbles also don't permeate entire markets. Bubbles are asset by asset. And there's a lot of froth in this market that I think would qualify as bubbles. Examples. Palantir recently hit a market value of over $500 billion. Trailing 12-month revenues, $3 billion. Okay, Now, what's the plausibility that a company with 3 billion in revenues could deliver net present value future profits to shareholders of 500 billion dollars? You'd have to see the sales, the revenues grow from 3 billion to 10 billion to 20 billion to 50 billion to 100 billion and then some over the course of the coming years. So if revenues aren't likely to reach 100 billion within 10 years, then you have an implausible pricing for Palantir. Second part of the definition, does the marginal buyer of Palantir care about discounted cash flow models? Of course not. That's not why they're buying. They're not buying based on, I analyze the revenues and I analyze the future profits and here's my projections. No, they're buying because they buy into the story. So yes, we have bubbles galore today. We had bubbles galore in the year 2000. I think there are many lessons to be learned from the dot-com bubble that are very applicable today and very useful to the long-term investor.
Let's just talk about some of those lessons, because I think it's a lot of times these things rhyme, but they're not exactly the same. So like, what similarities are here, which people that you talk to, but are there also some differences as well, in your opinion?
Well, starting with the differences, I think AI is a bigger deal than the internet. I think it will change our world more radically in the coming generation than the internet has in the past generation. But the similarities also abound. If you look at the dot-com bubble, I love looking at the top stocks in the dot-com bubble. What were they at the start of the year 2000? Microsoft was number one, most valuable company on the planet. It's still in the top three. It goes around 1, 2, or 3, but it's still in the top three. However, you had to wait 18 years for Microsoft to beat the S&P 500. That's a long time to wait. Now, what happened? The decade of the 2000s was terrible for the company. Then, under the new CEO, they regained their footing, regained their vision, and regained their momentum, and lofted past the S&P in year 18. That's a long time to wait. Number 2 on the list, GE, cresting on its way to irrelevance, lending money to its customers to buy its products. Ouch. Next was Cisco. Chambers, the CEO, was on TV in March of 2000 saying, I don't see why we can't grow at 40% a year as far as the eye can see. 40% a year after 6 years means, after 5 years means that you're 6 times as valuable, 6 times as much sales, profits, whatever. Where are they today? They're 6 times as big as they were 25 years ago. That's 8% growth, not 40. They were also lending money to their customers to buy their product. Next on the list was Intel. It had a moat. It was building, along with Cisco, it was building the infrastructure for the internet. And it had a moat. Nobody could dislodge it in the foreseeable future. Well, except for AMD, SML, Taiwan Semiconductor, AMD, and now NVIDIA. Okay, that means that it's been disrupted 4 times over in the last quarter century, and it's now the 5th biggest chip manufacturer in the world. That's daunting, and that's after a $50 billion cash infusion from the CHIPS Act. Last 2 on the top 6 list would be Lucent, doesn't exist anymore, and Nokia. Nokia still makes cell phones. Can you imagine? Nokia was 6th most valuable company in the world in the year 2000. World-straddling colossi destined for greatness, and only one has had a positive return. 1 out of the 6 has had a positive return in the last quarter century. Only one has beat the S&P. The other 5 have had negative returns for a quarter century. Yikes. So when we look at today's world-straddling colossi, wonderful companies, visionary leadership, a moat that can protect them from the competition, except when it can't. And the simple reality is disruptors get disrupted. So one of the lessons of the dot-com bubble is disruptors get disrupted. Another lesson is narratives shape prices. So don't bet on the narrative. That's going to do you no good. It's already in the price. Look for where the narrative might be off target. The narrative in the dot-com bubble was off target in two ways. One, the narrative said the internet's going to change everything, and it's going to happen fast. The narrative was correct on the first part. It changed everything, but it didn't happen fast. And the second place the narrative was wrong is these companies have moats. They're not going to be disrupted. Most of them were. So be careful about bubbles because they can burst. They don't necessarily take down everything around them with them. The bubble burst in March of 2000. Roll the clock forward 2 years. NASDAQ was down 50% on its way to an 80% drop. Meanwhile, the median stock in the Russell 3000 was up 20%. The Russell 2000 value, small cap value, was up 53%. So the bull market of the 1990s for the average stock didn't end until 2 years later. The bull market ended for the cap-weighted indexes because the dot-com companies were so dominant in those cap-weighted indexes. So many lessons from the dot-com bubble.
So would one of the practical takeaways be, for investors, I would imagine, a lot of investors' portfolios are heavily tilted towards many of the tech darlings, large cap growth stocks today. So would one of the important lessons be, let's get some diversification in, let's be buying other stocks in other categories like the value? I mean, what else? Trying to get like what practically can investors do here if they have these concerns?
Well, we're probably best known for having invented RAFI, the fundamental index, 20 years ago. And RAFI takes, let's say, the 500 largest companies in the United States, not 500 largest market cap, 500 largest businesses, and then weights them by the size of their business. So the growth stocks are going to be reweighted down. The Magnificent Seven are 34% of the S&P. They're 18% of RAFI. They're big businesses. They've been highly successful. They are magnificent. But we downweight them to their economic footprint. They aren't a third of the U.S. economy. Then we also have a rebalancing alpha. If a stock soars and its underlying fundamentals don't validate that price move, then RAFI will say, thanks for the nice gain, I'm trimming you back. If a stock tanks and its fundamentals don't, RAFI will say, thanks for the big discount, I'm topping it up. In so doing, you're contra-trading against the market's constantly changing views of what a company is worth. And you're turning volatility into alpha. So RAFI has a deep value tilt. It's every bit as value tilted as Russell value, but it has a rebalancing alpha. So globally, RAFI has beat MSCI's RACWI value index by about 2.5% a year for the last 20 years. 2.5% a year is a lot. It compounds nicely over time with only about 2% tracking error. So it's beat RACWI value in 15 out of 20 years. That's wonderful. So one thing you can do is, to the extent you want value as part of your portfolio, and you should, value is really cheap now, RAFI is a fantastic way to do it. Another thing that you can do is to look to broader diversification to liquid alternatives away from mainstream. U.S. stocks are expensive. I love using the Shiller PE ratio, price relative to 10-year smoothed earnings. Shiller PE ratio for the U.S. is 40 times the 10-year average earnings. That sounds expensive because it is. It's been higher than that once. Top of the dot-com bubble, it reached 44 times. So 40 times is in the 1% most expensive in history. Value is in the bottom 2 or 3% in terms of relative cheapness in history. It's as cheap as it was at the peak of the dot-com bubble. It's almost as cheap as it was after the COVID-induced value meltdown in the summer of 2020. And so value represents an extraordinary opportunity. Non-U.S. stocks are priced at roughly half the U.S. valuation multiples. Emerging markets are about 55, 60% off. Emerging markets value is priced at a Shiller P ratio of about 12. That's 70% off from U.S. S&P 500. RAFI, fundamental index, in emerging markets is priced at single-digit Shiller PE ratio. You can buy half the world's GDP for less than 10 times the sustainable 10-year average earnings. That's cool. Now, can I tell you that RAFI in emerging markets will beat the S&P over the coming year? No, of course not. But on a 10-year look-ahead basis, I would bet long odds that emerging markets RAFI and emerging markets value will soundly beat the S&P, and especially will soundly beat U.S. growth stocks. It's not that the growth narrative is wrong. These companies are rocking our world. They are changing our world. They are changing the way we live in more ways than we can possibly imagine. But they're priced for perfection. They're priced as if they won't be disrupted by other newcomers with even better ideas.
What are your thoughts on the AI CapEx spend? I want to get your thoughts because you're really good at putting things in a historical context, and we're seeing massive amounts of money spent. I mean, we're seeing companies that were effectively capital-light companies become asset-heavy companies very, very quickly. Like, do you have any thoughts or historical context you put this in terms of what they're doing and the possibility that that's going to produce, revenues and profits eventually that will justify that spend?
One very simple, very powerful message is that if you go back historically and you sort companies based on R&D expenditure, that's positively correlated with subsequent success as a stock, not just as a business. If you do the same with CapEx, it's negatively correlated. CapEx tends to be negatively correlated with future stock market performance. And so CapEx is dangerous. It's seductive. You feel like you've got to do it. You've got to play along to it's like the Red Queen, got to run twice as fast as you possibly can just to stay in the same place. That's the nature of CapEx. So it's dangerous, not because it won't produce the changes that we're expecting. It will, but because it won't necessarily do so profitably. One of the beauties of a well-functioning capitalist system is creative destruction. Spend money carelessly, and you could be making way for another company to displace you. One of the key elements of a healthy capitalist system is that for a business to succeed, it has to have happy customers. If you don't have happy customers, you will be a victim of creative destruction, and justly so. The simple fact is, if you look at NVIDIA, they have very happy customers. People are lining up for the privilege of getting on a waiting list to spend vast sums on the most expensive chips in the history of computing. Very cool. And a money machine until they're disrupted by somebody else or by other chip makers that catch up. Now, what about NVIDIA's customers? NVIDIA's customers have yet to find any way to transform that CapEx into revenues and profits. So the CapEx spend is dozens of times the magnitude of the revenues that are being produced by that CapEx spend. So that's not to say that there won't be revenues from AI. There will be. This puzzle will be solved in the years ahead. But for now, the companies doing the CapEx spending are having a dickens of a time trying to find a way to earn profits on that expenditure. That's a dangerous situation, and that's very symptomatic of, or very emblematic of what we already saw in the dot-com.
Yeah, I have like a value nature like you do. So one of the things I've been trying to challenge myself on is like, is there something different about AI? Like we had Kai Wu on who wrote a really good paper about this. And, you know, if you look back at the railroads or if you look back at the internet, like all this money that went into infrastructure, to your point before, resulted in great things for society, but bad things for the people who built the infrastructure. And I'm just wondering, is there something about this technology that's just different than other technologies? Because you talked about before, you know, you expect bigger things in the next decade, even in the internet. Like, is there something we're missing in terms of how great this technology is that maybe it's different this time? It's just something I think about. I don't know if you have any thoughts on that.
Firstly, this technological revolution is very real. It's one of many. You go back to the steam engine. It changed everything. You go back to 1825. 1825, the fastest way to get a message from New York to Washington, D.C. was on horseback, and it took 3 days. And that's with fast horses and changing them and riding a series of horses 20 hours a day. Then came the railroad. Now you could do it in 2 days. Then came the telegraph. Now you could do it like that. Talk about a technological revolution. It was staggering. And the people who created those revolutions became wealthy. But the big beneficiaries were the users, the end customers. So when I'm asked who are the big beneficiaries of AI, my answer is you, me, everybody. We're all big beneficiaries. Even those of us who have zero knowledge or interest in technology, it's going to rock our lives because it'll be made part of our lives in ways that we don't even notice. On the drive to this office here, I had a conversation with somebody about autonomous vehicles. AI is going to make autonomous vehicles able to drive without any traffic lights or stop signs, just know where each other is and zoom. And on city streets, bumper-to-bumper traffic flowing at 40 miles an hour. On freeways, bumper-to-bumper traffic flowing at 80 miles an hour. And all of that made possible by AI without any of us even knowing how it's done. So the big beneficiaries will be everybody. An ordinary retailer will figure out how to use AI without even realizing they're using AI to broaden their reach to their customers. So it's going to change everything. But the big beneficiaries aren't necessarily the obvious ones. It'll be the less obvious ones that are currently priced as if they're headed for oblivion, when in point of fact, most of them are going to be more prosperous in the future because of AI than they are today.
I was thinking about that because I was thinking it'd be ironic if, you know, obviously the average stock has underperformed these tech, you know, stocks by a lot. But what if ultimately those companies end up being the biggest beneficiary of AI, and maybe some of the things we've been seeing in terms of value underperforming and the average stock underperforming, like the AI carries down and that helps to change that in the other direction.
And the beauty of it is just like the internet. Everybody uses the internet, whether they think about it that way or not. And everybody's already using AI, even if they're unaware of it. I mean, OpenAI disrupted Google's core business model this year. Google's core business model is sponsored links and pop-up ads. That's where most of its profits come from. Well, you could use ChatGPT or Claude or Perplexity or whatever you want as your search engine, and you get no pop-up ads and no sponsored links. You just get a verbal answer to your question and 3, 4, 5 useful links. Well, that's what you wanted from Google. So what's Google's answer? They realize, okay, we're being disrupted. this is existential for us. We'd better have AI as part of our default response. And so that's what they have now. Meanwhile, OpenAI itself has been disrupted also this year by DeepSeek coming out of nowhere back in January. Chinese AI, ostensibly measured to be as powerful as ChatGPT 4.5, and ostensibly built with 1/100th the resources of OpenAI. Well, that rocks the world of AI. And now there's competing AI tools. Will OpenAI be the dominant player in 10 years? I have no idea. In 3 years? I have no idea. And yet you have Sam Altman telling a reporter just about 10 days ago, who had the nerve to ask, how with 13 billion in revenues can you commit to 1.4 trillion in spending and investment alongside your customers? How can you do that? That's 100 times your run rate revenues. And Sam Altman's answer was, well, if you don't like your stock, I'm sure I can find a buyer for it. That's a non-answer. Come on, it's a legitimate question. And he later clarified and said, well, our revenues are way better than 13 billion, and they're going to be 100 billion, 200 billion in very short order. He's suggested 2027, it could cross 100 billion. Maybe he's right. Even if it is 100 billion, can you still, even at that, can you commit to 1.4 trillion in spending? So you have huge expectations and huge promises for future growth that, again, back to my definition for the term bubble, are implausible. Discounted cash flow model would require implausible growth for OpenAI to be able to spend 1.4 trillion alongside its customers. So there's a lot of fluff. That's not to say that AI is any less consequential. I think it's the biggest revolution of the last half century. It may turn out to be the biggest revolution in technological history, but, you know, the railroad was big. The telegraph was big. Automobiles and planes were big. Medical innovations were big. The invention of the computer. My career, I've been really lucky. I started my career early days of computing. First computer I worked on when I was in high school was a digital equipment PDP-8 that had 4K of storage and could handle 2,000 to 3,000 instructions per second. Wow. And now you've got an iPhone that does, I think, 5 or 10 trillion calculations per second. I don't know the number, but something breathtakingly large. And that's all happened in my lifetime, and the advent of AI is happening sort of towards the end of my career. I hope to still be around in another 10, 20 years.
Are you using it a lot personally, though?
Oh, yeah. Yeah. I did a little demographics research last night. I'd heard someone say that 80% of all 80-year-olds who've ever lived are alive today. And I was curious whether that was true. So I did work using AI to scour databases to find out what was the world's population and what percentage of the population made it to age 80. And I came up with, no, it's not quite true. There's been about 200, no, it was 1.3 billion people have made it to 80 years old out of 100 billion who've ever lived. And that's about 6 times as many as are alive today. So what I heard was not true, but it took me 20 minutes on the internet to using AI to assemble a spreadsheet, to manipulate the spreadsheet, and bingo, get an answer to my question. I was curious. 5 years ago, I would have thought, that's an interesting thing. I don't have access to that data and don't know where to find it. And it would be a a whole weekend of work to answer a stupid little question. Well, I was willing to spend a half hour to answer a stupid little question, but and I use it for work. We write about 20, 25 research papers a year, and we self-publish them on our website. And each time we put an image, got a picture here behind me. It might be an image like that or whatever, where the image is supposed to capture the essence of the paper. 3 years ago, we would hire 3 graphic artists and say, here's our paper. Show us a picture that you think captures the essence of the paper. And whoever came up with the best picture that we chose to use, we'd pay them double. Okay, so that worked out really nicely. We got a lot of nice little images that were a fun way to kick off a paper. Starting early 2023, where we started using DALL-E and ChatGPT to create these images, and within 2 or 3 months, we found in 10 minutes it comes up with a half dozen images, and one of them is almost always better than anything that the graphic artists came up with. So I realized one of the careers that is most vulnerable to AI is graphic artist. And so we stopped using graphic artists, and AI comes out with these clever little images that are just wonderful as a way to kick off the start of a paper. So we use it in all sorts of ways that would have been unpredicted just a year before ChatGPT was launched.
Yeah, it's interesting. You can never predict who's going to be disrupted by these things either. Like, I remember when this stuff first came on, everybody was worried about truck drivers. And I'm sure eventually truck drivers will be disrupted by this, but they're not going to be the first ones to be disrupted by this. It was professionals like lawyers and things that no one guessed. So it's just hard to predict what these things are going to be.
Yeah, that's exactly right. Tax preparers, the list goes on and on and on. There will be millions of white-collar jobs lost. There will also be millions of jobs created. And that's the other element of technological revolutions. The Luddites were destroying mechanical looms because they were worried about the millions of jobs lost to mechanical looms. It used to be that people would use looms that were not run mechanically, were run using human hands to create cloth. And millions of people, a lot of them 10 and 12-year-old kids, losing fingers to their looms that were out of work and not bringing in income that helped feed the family. Was it horrible and disruptive to the families of these kids? Yeah, although there were a lot less lost fingers. And did anyone, one generation after those jobs were lost, did anyone regret those lost jobs?
No.
Computers. Advent of computers was 50s, 60s, 70s. Before that, a computer was a job description. It was a person who was very fast with math. It was a job. You could be a computer. Computers put computers out of work. Does anyone regret a person who's very fast with math not being able to do fast math to calculate something that can be done on a calculator in a split second? Of course not. Not even the person who had that job would regret it at this stage. So technological revolutions kill millions of jobs. Media loves bad news. So all of these jobs lost. But millions of jobs created. That's not newsworthy. And efficiency improved. That's not newsworthy until long after it happens. The other thing is people think this is going to radically change the rate of growth of productivity. That, I think, is a dangerous oversimplification because every technological revolution does that. So you need a technological revolution, a big one, every generation to create the productivity growth that we've enjoyed for the last 250 years. And if you don't have a technological revolution in any particular decade, you're going to have a stagnant economy for a generation. Well, we haven't had a stagnant economy for a generation in a long, long time because we keep having these technological revolutions that are just wonderful.
I want to switch to index construction because one of the cool things you guys do, like if you looked at my portfolio or if you looked at your portfolio, they're going to look very, very different than an index. But for a lot of your average people, they don't want to look that different from an index. And you guys have done a lot of work around, and you mentioned fundamental index before, you guys have done a lot of work around how can we make these indexes better. And some of your colleagues wrote a paper recently, which I thought was really interesting because everybody wants to sort of classify the index into, you've got the value section, you've got the growth section. And they sort of made the point, well, there's companies that maybe aren't both, or maybe aren't either of those. And maybe you don't want to own those companies that are either of those. So can you talk about that work?
We have done some work that, just to tip you off and your viewers off on something that's coming, we've created what I think is a trifecta. RAFI, introduced 20 years ago, is a better way to do value investing. I mean, relentlessly better. We beat value indexes 3 years out of 4 over the last 20 years and beat it by a wide margin. T-statistic on the global RAFI relative to cap weight value is now over 5. I've been in the quant community for my entire career. I've seen back tests with T-statistics of 4 or 5. I've never seen a live strategy with a T-statistic of 5 except this one. Well, that's cool. Second leg of the trifecta, RACWI, Research Affiliates Cap Weighted Index, we introduced 4 years ago. The U.S. RACWI has beat the S&P by 81 basis points a year with 99.96% correlation, with 95% overlap. If you only have 5% non-overlap and you're adding 81 basis points, that means that the stocks that we have and they don't are beating the stocks that they have and we don't by 16% per year. That's huge. So ETF Architect launched an ETF based on that index just 9 weeks ago. We're already, as of Friday, 29 basis points ahead of the spider. That's 3 basis points a week. That is so cool. And the third leg of the trifecta is a better way to do growth. So, what about growth? Growth indexes, we've had this stupid myth that a stock is growth or value. If it's cheap, it's value. If it's expensive, it's growth. No. If it's expensive, it's expensive. That doesn't mean it's growth. It means it better be growth or you're overpaying. But if it's expensive, the market clearly thinks there will be growth. And it's already in the price. If there isn't growth, you're in trouble. Now, we've gone back historically and we've said, are there lessons we can learn from RAFI? Yes, there are. Instead of choosing companies for an index based on its market value, why don't we choose companies based on its size? Well, if you're building a growth portfolio, why don't we choose companies for an index based on their observed growth rates? Wow, what a revelation. Choose growth stocks based on whether they're growing. Take the 25% of U.S. stocks that have the fastest growth. How do you measure that? Let's take 3 to 5 year growth in sales, 3 to 5 year growth in cash flow, 3 to 5 year growth in R&D spending if they break out R&D spending, because R&D is correlated with future growth. Got 3 different growth rates, average them, and take the 25% with the fastest growth. All right, now you've got a portfolio of fast-growing companies. Cool. What other lessons from RAFI? Don't cap weight it. If you cap weight it, you're weighting it in proportion with what the market thinks the growth will be. Weight it instead based on the dollar magnitude of the growth. If one company's had sales grow from $1 billion to $2 billion. And another company's had sales growth from $10 billion to $20 billion. They both qualify. That's doubling your revenues in 5 years is a terrific growth rate. They both qualify for the index, but one of them is 10 times as consequential in the economy, 10 times as big. Let's give it 10 times the weight. Let's choose companies based on percentage growth, weight companies based on dollar growth. If you do that, go back over the last 30 years and ask, how does this perform relative to Russell 1000 growth? 4% per annum incremental return. And oh, by the way, during the dot-com bubble, when frothy companies with no profits were soaring, companies that were fast growing and had profits were called GARP, growth at a reasonable price, and they were outperforming a little bit, but lagging way behind the frothy companies. Then the frothy companies crashed. The companies that had real growth continued to outperform. So the aftermath of the dot-com bubble, when Russell growth crashes, RAFI growth continues to outperform. So cool. So we think that we've revolutionized value investing. We've revolutionized cap-weighted investing, the broad market. And I think we're on the verge of revolutionizing growth investing.
And so when you put that together, when you put the value together with the growth, is what you're doing, you're excluding companies that basically don't meet either one of the criteria?
Right. Why do you want to own expensive companies with sluggish growth? In our research paper, we went back and we asked the question, if you just take the market and break it into above average growth and below average growth, and above average book to price ratio and below average book to price ratio, you've got 4 quadrants. And book to price, by the way, is a terrible measure. It's just the one that's popular in academia. So why reinvent the wheel for purposes of research? For purposes of product, we're not going to use that. But if you take expensive, cheap, fast growing, slow growing, the 4 quadrants go back over we took it all the way back to the late 60s. So you've got 65 years of data, 55 years of data. Over the last 55 years, cheap and fast growing perform best, beat the market by a little over 1%, 1.5% per annum. Simple cap weighting of the stocks in it. Cheap and slow growing added about 1%. Expensive and fast growing added about 1%. The best performing was cheap and fast growing. It was about 0.5% faster than the others. And way behind, over 2% per annum under the market per annum for 55 years, was expensive and slow growing. And this is not using any forward-looking expectations. This is just saying, objectively, is the stock cheap or expensive relative to the market in today's valuation multiples on book value? And is the company's sales or profits growing faster or slower than average? So super simplistic. Why would you want to own expensive companies that haven't demonstrated an ability to grow? What a dumb idea.
Do you have any feel for like how big of a percentage of the universe that is? Like these expensive companies that aren't growing?
Well, by definition, it's 1/4. But because they're cheap, it's 1/4 that represents less than 1/4 of the market value. An educated guess, I don't know the answer to your question, but an educated guess would be somewhere around 10 or 15% of the market would be excluded. So our growth, here's a fun factoid. 2 of the so-called Magnificent 7 don't make the cut for our growth index because their objective measures of growth are not in the top 25%.
I'm trying to think what it would be. Tesla?
Tesla qualifies, but barely.
You got any guesses, Justin?
I'm trying to think here. So I would think Apple.
Apple qualifies, but barely.
Okay.
You stumped the podcast host here, Rob.
Go through them. I mean, you got Mike.
Okay. Amazon and Alphabet
Okay.
don't quite make the cut. They both have good growth rates, but they're not top quartile. so they don't make it into our index. They would have a year or two ago, but not today. I think Tesla probably won't make it into our index in a year. We'll see. So, all right, these are Magnificent Seven. They are magnificent companies. They've got visionary leadership. They've done remarkable things. They've rocked our world. They've changed our lives. And they're priced for continuing to do so in the future. And yet, objectively, their rates of growth over the last 3 to 5 years have slowed to a point where they're no longer in the fastest growing quartile of all stocks. Really interesting stuff.
Is the reinventing the cap weighting, have we already talked about that, or is that a different?
Well, we alluded to it. Reinventing
Right.
cap weighting, RACWI, Research Affiliates Cap Weighted Index. I'm going to grossly oversimplify. S&P is selected by a committee, but most people think that it's the 500 largest market cap stocks cap weighted. That's actually not true. 400 of the S&P 500 would make it into the top 500 by market cap. So it's an approximation. But let's suppose you chose the 500 largest stocks by market cap and you weight them by market cap. That's what most people think is the S&P. Why would you do that? It means that if a stock has soared and its market value has come from well under the top 500 into the top 500, now you have to buy it after it's soared. And if a company has tanked and fallen off the top 500, you've participated in that horrible drop, and now you get out of it after it's fallen. You're buying high and selling low. People think of index funds and cap-weighted indexes as passive. They mostly are, but they trade. Call it 5% turnover roughly. So think of them as 95% passive, just along for the ride. We don't care if the stocks are up, down, or sideways. We don't care if the businesses are flourishing or floundering. Doesn't matter. We're along for the ride. Unless they flourish too little, flounder too much, and get kicked out. The active sleeve, where it's buying and selling, is wildly active. I like to joke that the active side of indexing is like Kathy Wood on crystal meth. Now, she's sweet, she's very religious, and she's conservative, so picturing her on crystal meth is a little hard. But if she ever took crystal meth, she would behave like the index committee at S&P. She'd be buying what's newly frothy just because it went up. She'd be selling what's newly hated just because it went down, with no further thought going into it than it soared enough, we got to buy it. It tanked enough, we got to sell it. What is the logic in that? Why not wait until the underlying business validates the price move? So a company soars. You wait until the business is among the 500 largest businesses in America. Now you add it. And that means you're not necessarily, you're adding the next NVIDIA or Tesla probably a handful of years after conventional cap weighting, but you're not getting drawn into buying the next Rivian, companies that soar and then crash. Who wants that? Flip-flops are the Achilles heel of index funds. Stocks that are kicked out of an index, over half of them were added less than 10 years before. Over a third of them were added less than 5 years before. So if a stock is added and kicked out in less than 5 years, what's the nature of the performance? On average, they outperform by 7,500 basis points in the year before they're added. And then they underperform by 7,000 basis points before they're kicked up. If you're outperforming by 75% and underperforming by 70, you're not back where you started. You're down 50%. That's awful. And then after it's kicked out, it outperforms by an average of 5% a year for the next 5 years. That's the essence of our work on deletions. And so basically what we have is an automated buy high, sell low discipline. If you use company size to choose what stocks to add or which stocks to drop, you're still going to be adding stocks that have outperformed, because if a company has grown faster than the economy and is in the top 500 companies, yeah, it's probably outperformed, but it's not being bought because it's soared. It's being bought because it's grown. It's not dropped because it's cratered. It's dropped because its business share has eroded. And so what you find is our flip-flops do a little bit of damage. Instead of underperforming by 7,000 basis points in the years before being added and dropped, they underperform by 2,000. That's still bad, but it's a third to a fourth as much damage. And that's why RACWI, over the last 4 years, live, has beat the S&P by 81 basis points a year. And over the last 35 years in historical testing has won by 69 basis points a year. Now, the early weeks of the Rouse ETF have been fortuitous. I mean, 29 basis points added in 9 weeks is pretty cool. But that's above average. That's larger than I would normally expect. I'd expect 1 to 2 basis points a week. We've had 3 basis points a week of outperformance.
Yeah. And by the way, on the deletions index, there is an ETF based on that as well that is being run. So for people that find that idea appealing, you can go and actually invest in that, which is pretty cool.
That's exactly right.
Yeah. Okay, so let's just, as we kind of wrap up here, we wanted to get your perspective on international markets. I mean, we've talked a little bit here that, I think you're a fan of the possible outperformance of emerging markets and international here as we look out over the next 7 to 10 years and we think about long-term returns. But when we had you on maybe at the beginning of the year, maybe end of last year, you talked about how most of your personal portfolio was, and you weren't advocating this for anyone else, but most of it was in emerging markets. And obviously emerging markets have had a really good year this year.
Yeah.
So just what's your overall view today on emerging markets?
Well, firstly, I'm a long-term investor. I never invest because I think something's going to outperform next year. I invest because I think something's going to outperform over the next 5 to 10 years. And so I tend to be a buy and hold investor, at least by the standards of today's investors. I view emerging markets value and fundamental index RAFI in emerging markets as the best single major stock market investment to choose today. RAFI in emerging markets is priced at less than 10 times the 10-year average earnings. That's very cool. And so we have a website, Asset Allocation Interactive. If somebody goes on Google and says Asset Allocation Interactive, the first non-sponsored website will take you straight to our tool. And our tool gives you forward-looking return expectations for 160 different asset classes. The highest return for major markets is emerging markets value at 10% annualized return expectation. Large cap growth for the U.S. is 1.5% per year for the next 10 years. 10% versus 1.5%, I'll take the 10. Does that mean that I have high confidence that that'll be the winner in 2026? No. I think it's 60-40 odds that it'll win on a 1-year basis. I think it's 80-20 odds it'll win on a 5-year basis and 90-10 odds that it'll win on a 10-year basis. I like looking at things long term, and on a 10-year horizon, I love emerging markets value. I love EFA value. Just plain old Europe and Japan value stocks are cheap. And within the U.S., the spread in valuation between growth and value in the U.S. is just about the widest in the world. The spread in valuation between small cap value and large cap growth is the widest in the world. So I don't think U.S. large cap value is cheap. I think it's cheap relative to growth. And to the extent I want U.S. large cap in my portfolio, I'll go with value every time. That's where we are today. So I see international markets as underutilized, underappreciated. The narrative is that American exceptionalism is real and therefore don't bother with non-US stocks. That narrative is in the price. US stocks, especially US growth stocks, are very fully priced. And all Europe or Japan has to do is exceed bleak expectations, and those stocks will turn out to have been bargains.
Yep. That's what I think a lot of investors fail to realize is that, it's usually almost always embedded in the price. And so, these things that are expensive, they're priced to perfection. And maybe the US market is kind of in one of those spots right now.
I think that's exactly right. I think the US is priced for perfection. Again, I say this again and again, don't short sell a bubble. It can last longer and go further than you can imagine. Fast way to go bust is to short sell a bubble. It doesn't mean you have to own it heavily. It doesn't mean you have to have it as your number one holding. It doesn't mean you have to own it at all, actually. But to the extent that you care about how you're doing relative to the market, then use a soaring stock market or a soaring market for U.S. growth stocks to trim your holdings, to say, thank you for those gains. I'm going to take some gains off the table. I'm going to start playing with house money. And if you do that, average your way into what's cheap, average your way out of what's expensive. We all hear about averaging in. How about averaging out? Averaging out is just as powerful a discipline and is overlooked. Nobody wants to sell what's given them great joy and profit. And yet, if you trim it, don't sell it, trim it. That can be a very prudent and sensible thing to do, and average your way into what's unloved.
So just in closing, is there any new areas of research that you're focused on, and or are there any new ideas that you're thinking of bringing? Because some of these ETFs are, they're newer, so you're launching actual product off of your research. So is that something that you think the firm will continue to do as well?
I think we'll continue doing that. I love the fundamental growth idea. If somebody says, wow, I hear you're doing great stuff on growth, how do I invest in it? Unfortunately, there's no products available yet. There will be. Other areas that in my personal portfolio, I love doing long short work. The RACWI Research Affiliates Cap Weighted Index versus S&P. Like I said, it has 95% overlap. Now, if over the last 4 years you've added 81 basis points a year with 95% overlap, that means that what we're overweighting, 5% of the portfolio, beats what they're overweighting, 5% of the portfolio, by 20 times that, which is 1,600 basis points per annum, 16% a year. But so if you build a long short, that's a pretty nice rate of return. But you don't have to stop there. You can leverage it. Let's leverage it 2 to 1. Now you've got 40 times the return difference. You're taking that 80 basis points and turning it into 30+%. I can do that in my personal portfolio. I do that in my personal portfolio. It's very cool. Can we create that as a product? Yes, we can. Is that going to be a product that's available at some point in the coming couple of years? Maybe. We're looking into feasibility and regulatory issues. It sounds wildly reckless. 40 times long RACWI, 40x short S&P, but it's really not. It's just the 5% leveraged up 2 to 1. I've been doing that live in my personal portfolio since May, and it's been a better than average 6 months. So that's made about 30%, about half of that since the launch of the Rouse ETF. So I'm doing Rouse on a heavily leveraged basis in my personal portfolio. I eat my own cooking.
Well, it's great to have you, and we kind of have this inside seat, if you will, to the research you guys are doing and maybe some future products. So it'll be great to see the developments that come out of Research Affiliates. Thank you, Rob.
Thank you so
Thank
much.
you, Rob.
This has been fun as always. Thanks.
Thank you for tuning into this episode. If you found this discussion interesting and valuable, please subscribe on your favorite audio platform or on YouTube. You can also follow all the podcasts in the Excess Returns Network at excessreturnspod.com. If you have any feedback or questions, you can contact us at excessreturnspod@gmail.com.
No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of the firms of the hosts or their clients.